Welcome to Wall Street Weekly. Today's deep dive it's going to be a heavy one. We are unpacking an absolutely massive stack of market data spanning the week of May 11th to May 15th, 2026.
Yeah, heavy is probably the best word for it. It was a historic week.
Truly. And, I was trying to think of the best way to describe this week to you, the listener.
Hmm.
And imagine you're throwing this massive, champagne-soaked penthouse party to celebrate your wealth, right?
Right.
And you are completely oblivious to the fact that the basement of your luxury building is currently flooding, flooding with oil and rising interest rates. You're up there on the top floor, the music is blasting, everybody's dancing, and you think you are just totally immune to the real world.
That is the perfect visual because for the first 4 days of last week, that was Wall Street.
Yeah.
The equity markets were throwing this, historic celebration on the top floor. And they were actively, and I mean actively, ignoring the catastrophic damage happening to the structural plumbing down below.
Yeah, true.
And when that foundation finally snapped on Friday, the party didn't just stop. The floor completely fell out from underneath them.
Exactly. So look, if you are listening to this right now, whether you are a retail investor looking at your 401k and just wondering where all your returns went, or maybe a portfolio manager trying to navigate this sudden volatility, or honestly, just someone trying to understand why your grocery bill is climbing while your paycheck seems to buy less, this deep dive is exactly for you.
Yeah, we're going to map out exactly where the smart money is moving right now.
Right, and why the foundational plumbing of the market broke so violently this week. And most importantly, what you need to watch as we head into next week from May 18th to the 22nd.
And to really, to truly comprehend the severity of the crash on Friday, we have to start by measuring the sheer height from which the market fell, right?
Yeah.
We need to look at the absolute euphoria that characterized Monday and Thursday, because the fall is only catastrophic if you understand the altitude.
Yeah, let's spend some time on that illusion of immunity, this incredible disconnect between the technology sector and basically the rest of the macroeconomic reality.
Yeah.
Because Monday started off looking like, I don't know, the financial party of the century.
Oh, it really did.
We saw the S&P 500 and the Nasdaq hit brand new all-time highs. The S&P closed Monday at 7,412.84. The Nasdaq closed at a staggering 26,247.13.
Which, those are monumental historic numbers, especially when you start to overlay the macroeconomic storm clouds that were already gathering on the horizon.
Right. And it seemed like the semiconductor and AI infrastructure trade was just entirely divorced from anything happening in the real economy. It was like they were existing in a completely separate universe.
Completely isolated.
Yeah. We're talking about the PHLX semiconductor index. The SDX jumped 2.6% on Monday alone. You had Intel rallying 5% just on the news of a manufacturing agreement with Apple. You had Qualcomm hitting an absolute record high.
It was crazy.
It's like tech investors had their noise-canceling headphones on. They were blasting AI earnings reports at maximum volume and just completely ignoring the fire alarms going off in the rest of the economy.
That concept, the noise-canceling headphones, that is exactly what we call the valuation ceiling. And it is incredibly vital that we establish the mechanics of this ceiling before we even get to the Friday crash.
Okay, let's unpack that.
Because the market entering this week, it was priced for absolute perfection. It was priced for a reality that simply did not exist. When institutional investors look at whether a market is expensive or cheap, one of the primary tools they use is the Shiller PE ratio.
Right, so let's break that down for the listener really quick. PE is price to earnings, but what makes the Shiller PE different?
Good question. So it's a cyclically adjusted price-to-earnings ratio. It takes the earnings of the S&P 500 companies and it smooths them out over 10 years, adjusting for inflation. Yeah, so it prevents one abnormally good or bad year from skewing the valuation. And coming into this week, that Shiller PE was floating above 42 times earnings.
Wait, 42x?
Yeah.
Let's put that in historical context. What does it actually mean to pay 42 times earnings for the market?
It puts us in the 99th historical percentile.
Wow.
Yeah, to put that in human terms, out of the entire history of the United States stock market going back over a century, valuations have almost never been this stretched.
That's terrifying.
It means investors were willingly paying a massive, unprecedented premium today for cash flows they expect to earn years into the future. And they were justifying that massive premium based on two foundational assumptions.
Okay, what were they?
First, they assumed that corporate profit margins would continue to expand flawlessly without any hiccups whatsoever. And second, they assumed that the Federal Reserve was going to cut interest rates, which would keep the cost of capital dirt cheap.
But wait, I want to push back on this a little bit, because if I am an investor looking at the data we got on Thursday, it really felt like those assumptions were kind of justified.
I can see why you think that.
Right. I mean, the Dow Jones Industrial Average crossed 50,000 for the first time since the Middle East conflict began. It closed Thursday at 50,063.46. And we got April retail sales data that surprisingly grew by 0.5%. It actually beat Wall Street's estimates.
Yeah, the headline numbers looked great.
Exactly. And on top of that, Cisco Systems skyrocketed 13.4%, which the sources note was its best single day in 15 years. And that was all driven by what the company described as voracious AI infrastructure demand.
Gracious, yeah.
So I had to ask, wasn't the optimism somewhat warranted? Consumers are spending, tech companies are seeing historic demand. Why shouldn't we celebrate that data? Why was famed investor Michael Burry warning as early as Monday that the tech rally had, quote, jumped the shark?
That is the trillion-dollar question right there. And it requires us to peel back the layers of that data. You are exactly right that the headlines looked incredible. But Michael Burry, and really the broader fixed income market, they were looking beneath the surface.
Looking at the basement, going back to our analogy.
Exactly. They weren't looking at the headlines, they were looking at the plumbing. Let's take that retail sales number you mentioned. Yes, retail sales being up 0.5% sounds absolutely fantastic on a television ticker. But you have to ask how that growth was achieved.
Okay, how was it achieved?
No? If the total dollar amount spent at the register goes up by 0.5%, but the underlying cost of the goods being purchased went up by 1% due to inflation, you aren't actually selling more physical goods. You are selling fewer goods, but just charging more money for them.
Ah, okay. Wow. So the nominal revenue goes up, the cash register says a bigger number, but the actual physical volume of economic activity, like the amount of stuff moving from the store to someone's house, isn't necessarily healthier. It might actually be shrinking.
Precisely. It is an illusion of growth, totally masked by inflation. And this highlights the danger of narrow leadership in the market. The equity market on Monday and Thursday was functioning as a pure momentum machine. It was entirely driven by mega-cap technology.
It's just tech carrying everything.
Right. The Russell 1000, your large-cap index, was holding the entire weight of the market on its shoulders. But Burry's jumped burst. The shark warning was prescient because he understands market history. He knew that you simply cannot sustain a Shiller PE of 42x if structural inflation is returning to the system.
Because the math just breaks.
High valuations mathematically require low inflation and low interest rates, period.
Because if inflation comes back, interest rates go up to fight it. And suddenly, if you were an investor, sitting in a safe U.S. Treasury bond paying you a guaranteed 5% looks a whole lot more attractive than risking your hard-earned capital in a tech stock that is trading at 42 times its earnings.
Exactly. It completely alters the calculus for the cost of alternative capital. Why take the equity risk when the risk-free rate is paying you handsomely?
It's a no-brainer.
And that brings us directly to the data that actually dictates that cost of capital. Because while the tech sector was, popping champagne on Monday and Thursday, Tuesday and Wednesday delivered the macroeconomic data that ultimately flooded our metaphorical basement.
And Michael Burry's warning implies a fatal flaw in paying 42 times earnings for a stock. Like you said, high valuations require a world where money is cheap. And as we saw on Tuesday, the cost of just keeping the lights on in this economy was about to violently increase.
Violently is the right word.
Let's talk about the inflation pipeline bursting, because Tuesday and Wednesday were an absolute bloodbath for anyone who was still clinging to the hope of a soft landing for the economy. On Tuesday, we got the April Consumer Price Index, the CPI, and the sources show it came in blisteringly hot.
Much hotter than any economist wanted to admit, and it showed a deeply troubling internal composition.
Yeah, let's look at the headline number first. Headline CPI hit 3.8% year over year. That is a massive aggressive jump from the 3.3% we saw just 1 month prior in March.
A huge acceleration.
But here is where it gets really interesting and honestly terrifying for the average consumer listening to this. The headline number is bad, but the core elements, like the unavoidable things people actually have to spend money on to live their lives, those components spiked out of control.
It really did.
The data shows airline fares jumped 20.7%. Overall transportation costs were up 7.1%. But the absolute kicker, the statistic that really tells the story of this economy, is that real average weekly earnings actually decreased by 0.19%.
And right there in that one statistic, you have the tragic irony of this specific inflationary environment.
It really is a tragedy. Let's make sure we clearly define real average weekly earnings for everyone. That means you take a worker's paycheck and you subtract the rate of inflation, right?
Correct. It measures their actual purchasing power. And when that number goes negative, it means inflation is officially outstripping wage growth.
So the average person is actually getting poorer week by week. Even if their boss gave them a 3% raise this year, if inflation is running at 3.8%, the dollars in their pocket are physically buying less at the grocery store. They're moving backward financially.
They are losing ground every single day.
Which perfectly explains the sector reaction we saw on Tuesday. We saw consumer-facing stocks just get hammered. Companies like Under Armour and Hims and Hers dropped a staggering 14% in a single day.
Because the market is forward-looking. If a consumer's real wages are negative, they aren't going to the mall to buy a new $60 moisture-wicking athletic shirt from Under Armour.
Right.
They aren't buying elective consumer health products. They were desperately trying to stretch their shrinking paycheck to cover rent, groceries, and gasoline. Discretionary spending simply evaporates in that environment.
It's the first thing to go.
Exactly. But if we connect this to the bigger picture, the consumer price index is just the tail end of the inflation pipeline. It's the final price the consumer pays at the register. The truly alarming data, the data that actually caused the structural panic on Wall Street, came out the following day on Wednesday.
The producer price index.
That's the PPI.
Yes. If the CPI is the end of the pipeline, the producer price index is the beginning of it. It tells us what businesses are paying for their raw materials, their logistics, their warehousing, their wholesale inputs.
And Wednesday's PPI data was just a systemic shock to the financial system. It skyrocketed 1.4% month over month. Year over year, wholesale inflation hit an unbelievable 6.0%.
6.0%. It's staggering.
It is the highest level we have seen since December 2022, and it completely shattered Wall Street's estimates. I mean, it was triple what the consensus of economists was expecting. Even when you look at core PPI, which strips out the historically volatile categories of food and energy to find the underlying trend, that number also tripled expectations, coming in at plus 1.0% month over month. Okay, we need to stop and really break down the physical mechanics of this. Why is a 6.0% PPI terrifying for the stock market? If I'm an investor looking at my portfolio, why does wholesale inflation scare me more than consumer inflation?
That's a great question, yeah. Lay it out for us.
It comes down to two devastating words for equity investors: margin compression.
Margin compression.
Let's walk through a typical example. Think about a mid-sized American manufacturing company. Maybe they make industrial plumbing valves. Their wholesale costs just went up by 6%.
Okay.
The steel they need to cast the valves, the diesel fuel to ship them across the country, the electricity to keep the heavy machinery running in their factory, the cost of all of that just surged by 6%. Now, in a normal, healthy economy, that company would just pass that 6% cost increase on to their customers by raising the price of the final product.
Right. But we just established on Tuesday that the consumer's real wages are falling by 0.19%. The consumer's broke. So if this plumbing valve company raises their prices by 6%, what happens?
They destroy their own demand. The broke consumer or the struggling contractor buying those valves simply stops buying. They delay the project, or they find a cheaper, lower quality alternative. So the manufacturer is trapped. They cannot raise prices without killing their sales volume.
Which means they have to eat that cost.
Exactly. They have to absorb that 6% inflation internally. So their top-line revenue might stay flat, but their underlying costs just exploded. Mathematically, that means their profit margins compress. They make less money on every single item they sell. Wow. And remember, the valuation ceiling we discussed. The stock market was sitting at a 99th percentile Shiller PE of 42x. That price was based on the absolute guarantee that corporate profits would expand.
Now they're shrinking.
Right. When a 6% PPI guarantees that profits will actually compress, the entire justification for the market's current price vanishes into thin air.
And as if that data wasn't enough to shake the market's confidence, right in the middle of this blistering inflation read, we get a massive, paradigm-shifting leadership change in the economy. The U.S. Senate officially confirmed Kevin Warsh as the new Federal Reserve Chair, taking over the helm from Jerome Powell.
The beginning of the Warsh era.
The Warsh era, yeah.
Yeah.
And the market's reaction was instantaneous and violent. There are these metrics called FedWatch tools, which track the probability of where the market thinks interest rates are going based on futures contracts. Instantly upon his confirmation, those tools priced in a 32% chance of a rate hike by December.
A hike, not a cut.
Right. We went from a market that was entirely banking on multiple rate cuts to sustain the tech rally to suddenly bracing for rate hikes. How did one man's confirmation flip the script so fast?
Because Kevin Warsh is historically viewed by institutional Wall Street as a stringent hawk. His academic and professional history shows that he prioritizes fighting inflation above almost everything else, including short-term stock market performance.
He's not going to bail out the stock market.
No, he is not. So, when a known inflation hawk takes control of the Federal Reserve on the exact same week that wholesale inflation hits a blistering 6%, the market instantly recognizes that the era of easy money is officially dead. The Fed cannot, and under Warsh, will not cut interest rates to support equity valuations when pipeline inflation is running at triple the expected rate.
Which brings up the most crucial underlying mechanism of this entire deep dive. We have to ask the fundamental question. What is physically causing this massive 6.0% surge in wholesale costs? Where is this inflation coming from?
Right, what's the root cause?
Because it isn't coming from a booming economy or rampant consumer demand. It all leads back to the Middle East and the world's most critical energy transit choke point.
The Strait of Hormuz. You simply cannot analyze inflation or the bond market in 2026 without thoroughly examining the geopolitical reality of global energy supply chains.
Let's lay out the timeline from the sources, because the geopolitical dominoes fell very quickly over the weekend, setting up this market collapse. Prior to Monday's market open, President Trump officially rejected Iran's latest peace proposal. He essentially put a 10-week-old ceasefire on life support.
Yeah, that was the catalyst.
And the primary sticking point in the negotiations was that Iran demanded a total lift of the naval blockades that are currently in place.
And we're seeing the physical reality of this diplomatic impasse from space. Satellite imagery released this week showed Iranian oil exports at a virtual standstill. The tankers simply aren't moving.
Which is huge.
That is millions of barrels of crude oil entirely removed from the global market ecosystem on a daily basis.
Right. And the diplomacy is ongoing. The sources note that Trump even traveled to Beijing this week for a summit. The goal was to pressure President Xi Jinping to use China's leverage, since China is historically Iran's largest oil buyer, to force some sort of concession or breakthrough.
Right. Trying to bridge the deadlock.
But regardless of the political maneuvering or the high-level summits, the physical reality of the oil market on the ground is collapsing.
And using the word collapsing is not hyperbole. The International Energy Agency, the IEA, put out a report this week that sent absolute shockwaves through the energy sector and trading desks globally.
The numbers in this IEA report are staggering. I want to read them slowly so we can really grasp the scale of the physical shortage. The IEA reported an unprecedented global inventory collapse. They noted that 4 million barrels per day were drawn down from global reserves just in March and April.
4 million a day.
Currently, there are 14 million barrels per day of production entirely shut in. And by Thursday, the IEA confirmed a cumulative supply loss of over 1 billion barrels since the conflict began.
That's billion.
1 billion barrels. They even had to take their entire 2026 global energy forecast and flip it upside down, going from a projected supply surplus to a massive 1.78 million barrel per day deficit.
Let's unpack what it actually means when the IEA says 14 million barrels per day are shut in. This isn't like turning off a faucet in your kitchen where you can just twist the handle and the water flows again instantly.
How does it work then?
Well, in the oil industry, shutting in production is a massive, highly destructive logistical undertaking. You have to physically cap the wellheads, you have to depressurize pipelines, you have to reroute massive supertankers.
Sounds incredibly expensive.
It is. And you end up laying off the specialized rig workers who operate the machinery. When an oil well is shut in, it takes months, sometimes quarters, to bring it back online safely and get the crude flowing back to refineries.
So even if a peace treaty was signed tomorrow, the oil doesn't just magically appear the next day.
Exactly. The supply chain has been structurally severed. And if we connect this to the bigger picture, oil is the literal lifeblood of the global industrial economy.
Right.
When you permanently remove 1 billion barrels of oil from the global system, you aren't just making gasoline more expensive for commuters. Crude oil is the foundational input for almost everything.
Yeah, people forget that.
You are raising the cost of asphalt for roads. You are raising the cost of synthetic fertilizers for agriculture, which drives up food prices. You are raising the cost of maritime shipping, aviation fuel, and plastics manufacturing. This missing billion barrels is the physical root cause of that 6.0% PPI print we discussed earlier. This is what we call the structural war premium.
And the commodity markets reacted violently to this realization. For the week, Brent crude, the international benchmark, surged 4.85%, hitting $109.26 a barrel. West Texas Intermediate, or WTI, crude the U.S. domestic benchmark, jumped even higher, rising 7.49% to hit $105.42.
Huge moves.
But here's a specific data point from the sources that really caught my eye, and I need you to explain this mechanism. The price difference between WTI and Brent narrowed aggressively by 37.46%.
Yeah, that was fascinating to watch.
Why is that specific spread collapsing so fast? How does a blocked strait in the Middle East cause U.S. oil prices to skyrocket faster than international prices?
This is one of the most fascinating mechanical details of the global commodities market, and it tells a story of pure panic.
Okay, lay it on us.
Let's look at the two benchmarks. Brent crude largely reflects oil pulled from the North Sea and the Middle East. It is the benchmark for the rest of the world. WTI is pulled largely from Texas, the Permian Basin, and the U.S. Gulf Coast.
Right.
Now, normally, Brent trades at a healthy premium to WTI. It is usually more expensive. But because the Strait of Hormuz is functionally blocked, European and Asian refiners are suddenly looking at a massive, immediate shortage of physical oil. They literally have massive refining facilities that will have to shut down if they don't get crude oil to process.
So an Asian refinery manager wakes up, realizes the tanker from the Middle East isn't coming, and they panic.
They absolutely panic because shutting down a refinery costs millions of dollars a day. So they execute what traders call a scramble for barrels. They pick up the phone and desperately start trying to buy any physical oil they can find from regions that are safe and accessible.
Oh.
Yeah, they start aggressively bidding for light, sweet crude varieties from West Africa and, critically, the United States.
So all of this international demand suddenly floods into the Texas oil market.
Precisely. This massive influx of desperate international buyers bidding up American energy out of pure necessity drives the price of U.S. WTI up much faster than Brent.
That makes total sense now.
Their rapid 37% narrowing of that spread is the market's physical polygraph test. It tells you that global supply chains are genuinely broken, and buyers are willing to pay any price to secure domestic U.S. oil because they simply cannot rely on the Middle East.
And it isn't just oil. Henry Hub natural gas rose 1.72% for the week, pushing up toward $3. The sources note this specific increase is due to industrial fuel substitution.
Yep.
Industrial manufacturing plants are looking at $105 crude oil. They're looking at astronomically expensive diesel fuel to run their operations, and they're actively substituting it with natural gas to keep their power plants running.
Which introduces a whole new vector for inflation, because as industrial plants buy up natural gas, it puts a price floor under the commodity, which ultimately raises utility costs for domestic households across the United States. It's a cascading effect.
So we hear about supply shocks all the time in financial media. We talk about the 1970s Arab oil embargo. We talk about the supply chain shocks during the early 2020s pandemic lockdowns. But the IEA is explicitly calling this an unprecedented supply shock in modern history.
It's historic.
It feels fundamentally different. So the question we have to ask is this war premium just cyclical, meaning it will go away as soon as a peace treaty is finally signed? Or is it permanently structuralizing inflation for the rest of 2026?
That is the core debate raging on Wall Street trading floors right now. But the consensus moving out of this week is that the inflation is becoming structural.
Wow.
Even if President Trump and President Xi manage to broker a miraculous ceasefire next week, the damage is done. The IEA noted that the global market will remain severely undersupplied until at least October.
Because of that shutdown process you mentioned earlier.
As we discussed, you don't just replace 1 billion missing barrels overnight. The physical inventory depletion across the globe is so incredibly severe that it has structuralized a higher permanent floor for inflation. The cheap oil is gone, and the cheap goods that rely on it are gone with it.
Which brings us to the Friday fracture. Because all of these realities collided at the end of the week. You simply cannot have 6% wholesale inflation and $109 oil without the bond market demanding a higher return for its money.
Right.
Up until Thursday, the stock market was wearing its noise-canceling headphones, ignoring all of this. But by Friday, the fixed income market officially took back control of Wall Street.
The basement flooded, the water reached the electrical room, and it completely short-circuited the elevators to the penthouse.
Exactly. Let's look at the fixed income massacre on Friday, because the numbers are stark. The 10-year Treasury yield, which is the benchmark for global borrowing, hit a one-year high of 4.60%.
Huge move.
It ended the week up an astonishing 4.15%. The two-year yield surged over 4.08%, and the 10-2 spread, the difference between the 10-year and two-year yields, widened by 9.89%.
We need to pause on that 10-2 spread widening. A steepening yield curve, especially in an environment where absolute yields across the board are rising rapidly, is a classic historical warning sign of stagflation.
Let's define stagflation for the listener, just so we're all on the same page.
It is the absolute worst-case scenario for an economy. It means economic growth is stagnating, falling real wages, struggling consumers, while inflation simultaneously remains high.
A toxic combo.
Extremely toxic. When the 10-year yield rises faster than the two-year yield, it means bond traders believe inflation is going to be sticky and persistent for a very long time, demanding higher long-term compensation, while they also fear near-term economic destruction.
And the panic in the bond market was off the charts.
Yeah.
We look at the MOVE index, which measures bond market volatility. Think of it as the VIX, the fear gauge, but specifically for U.S. Treasuries. The MOVE index spiked 12.91% for the week.
And here is the exact mechanism that every equity investor needs to understand. There is a severe, unforgiving negative correlation right now between the S&P 500 rate of change and the MV index.
Meaning they move in opposite directions.
Right. As bond market volatility exploded on Friday, as yields violently repriced higher, it acted like a massive gravity well. It violently dragged equity valuations down with it.
The stock market takes the stairs up, but the elevator down. It took 4 full days to build those record highs to push the Dow over 50,000, and it took one single afternoon of bond market panic to wipe it all out.
Brutal.
On Friday, the S&P 500 dropped 1.08%, the Nasdaq crashed 1.36%, and the Dow fell 0.98%. And those high flyers we talked about earlier, the companies that thought they were immune, NVIDIA, Amazon, Applied Materials, they faced intense, aggressive sell-offs. The VIX, the Equity Volatility Index, spiked over 7% to hit 18.50.
Let's take a moment to explain why rising yields specifically crushed technology stocks. Why did a jump to 4.6% in the 10-year Treasury trigger a massive sell-off in AI companies?
Yeah, what's the connection there?
It all comes down to the mechanics of how these companies are valued. High-growth technology companies, the AI darlings of the market, derive a massive portion of their current stock price from cash flows they expect to earn 5, 10, or even 15 years in the future.
Because they are spending billions to build the infrastructure now, with the promise that they will dominate the future economy.
Right. But to figure out what those hypothetical future earnings are actually worth to an investor today, Wall Street analysts use what is called a discounted cash flow model, or a DCF.
Okay.
They have to discount those future profits back to the present day. And the rate they use to discount them is the risk-free rate, which is the 10-year Treasury yield.
Let's do an ELI 5 on this. Explain it like I'm 5 years old.
Okay. Think of a high-growth tech stock, like a promise to pay you $100 in 10 years. If inflation is 0 and the risk-free rate is near 0, you'd gladly pay $99 for that promise today. The future money is almost as good as today's money.
Makes sense.
But if the risk-free rate suddenly spikes to 4.60% and inflation is running at 6%, that $100 won't even buy a cup of coffee in a decade. So you aren't going to pay $99 for it today. You might only be willing to pay $50 for that ticket today.
It's just gravity. If I can get a guaranteed, risk-free 4.6% return right now from the United States government, I am absolutely not going to pay a massive premium for a tech company's hypothetical profits a decade from now.
Exactly. This mathematical reality forces what we call multiple compression. The Shiller PE ratio, which we established was over 42, forcefully dropped down to 41.66 by Friday's close.
It just squeezed it down.
Investors aggressively adjusted the price they were willing to pay for future growth because the cost of capital just got fundamentally too high to justify the risk.
And as if all of this macroeconomic pressure wasn't enough, as if the physical supply chain wasn't already a nightmare with the oil blockades, we got a massive legal curveball thrown at the markets on Friday regarding tariffs.
Yes, the Section 122 tariffs. This was a brutal surprise for corporate balance sheets.
Yes. The U.S. Court of Appeals for the Federal Circuit placed a temporary stay on the repeal of the Section 122 tariffs. This was a massive shock to corporate legal teams across the country.
Totally blindsided them.
Essentially, American importers thought these emergency 10% surcharges on manufactured goods had been declared unlawful and were going away. They had built their Q3 and Q4 profit models assuming that cost was disappearing. But this appeals court decision means the 10% surcharge legally stays in place while the appeal is pending.
Which is devastating for supply chains. Let's walk through how this compounds. Multinational corporations are now stuck. They have to keep paying a 10% duty on their global sourcing.
Ouch.
So you take a 10% tariff surcharge, you compound that with $109 crude oil shipping costs, you compound that with a 6% underlying wholesale inflation rate. The cascading effect through the supply chain is exponential. You have a recipe for persistent, unyielding cost-push inflation that companies cannot escape.
So when the dust finally settled on Friday afternoon, a very clear, very stark picture emerged of the market's anatomy. We saw exactly which sectors could survive this new stagflationary environment and which ones were drowning. Let's break down the winners, the losers, and what I find most fascinating in the data, the capital size divide.
Friday was a textbook illustration of intermarket sector rotation. Institutional money was aggressively picking winners and losers based on the new macro reality. Let's start with the Russell indexes, because they tell the story of the capital size divide perfectly.
Okay, looking at the data. The Russell 1000, which tracks the largest, most established companies, was down slightly for the week, just negative 0.17%. It was mostly insulated early in the week by those cash-rich tech giants we discussed.
Right, the mega caps held it up.
But as you move down the size spectrum, it gets remarkably ugly. Midcaps fell 1.82%, and the Russell 2000, which tracks small-cap companies, was absolutely crushed, down 2.69%. Why such a massive disparity between the big guys and the little guys?
It all comes back to debt structures and how these companies finance their daily operations. A mega-cap tech company like Microsoft or Apple is sitting in a fortress built of billions in cash.
Right.
High interest rates actually benefit them in the short term because they earn more interest yield on their massive cash piles. But small-cap firms in the Russell 2000 think of a mid-sized regional plumbing supply company. They don't have a giant cash cushion. They are highly dependent on floating-rate corporate debt and short-term credit lines just to make payroll, pay rent, and buy inventory.
So basically, Apple is earning interest, while the plumbing supply company is maxing out their credit cards just to survive because their loan rate just doubled.
Precisely. When the 2-year Treasury yield crosses 4%, the borrowing costs for that small-cap company instantly skyrocket. It directly threatens their survival.
It's an existential threat.
Tight monetary conditions create a stark divide. Cash-rich tech giants can weather the storm, but credit-dependent small enterprises face an immediate existential threat. That is why the Russell 2000 experienced an absolute bloodbath.
That explains the size divide perfectly. Now let's look at the sectors. The clear winner this week, the ultimate safe haven, where the smart money rushed in, was energy. The XLE ETF was up 3.97%.
Which makes perfect logical sense. Institutional capital aggressively flooded into heavy upstream producers and oil service providers. When Brent crude hits $109 a barrel, companies like ExxonMobil and Chevron become massive, unstoppable, cash-generating machines.
The ultimate inflation hedge.
Energy became the market's primary structural inflation proxy. If you believe inflation is going up because of oil, you buy the oil companies to hedge your portfolio.
And the only other real winner was consumer staples, the XLP, up 1.52%. The data notes that companies like Walmart and Costco saw heavy capital inflows as families traded down.
The trade-down effect is the hallmark of a squeezed consumer. We discussed the negative real wages. Because families are losing purchasing power, instead of going to expensive specialty organic grocery stores, they're going to Walmart and Costco to buy bulk necessities.
Just trying to get by.
They are trying to survive the inflation tax by shifting their consumption to discount retailers.
Which perfectly explains the losers. Consumer discretionary, the XLY, dropped 2.38%. Apparel, luxury goods, leisure activities. That spending is completely evaporating because gas is over $4 a gallon and airline tickets are up 20%.
It just disappears.
But wait, here is what genuinely confused me when I read the data. Materials dropped 3.75%. Utilities dropped 2.81%. And real estate dropped 3.01%. Normally, utilities and real estate are seen as the ultimate safe defensive sectors. They are the boring, steady dividend payers that grandmothers hold in their retirement accounts.
Right, the widow and orphan stocks.
Exactly. Why did the traditional playbook completely fail here? Why did they drop around 3%?
Because you have to understand why people buy those sectors. They are yield-sensitive sectors. People buy utilities and real estate investment trusts or REITs almost entirely for the dividend yield they produce.
Okay, I follow.
Let's say a major utility stock pays a reliable 4% dividend. That 4% looks absolutely fantastic when a government bond is only paying 1%. You gladly take the equity risk. But when the 10-year Treasury yield violently spikes to 4.60%,
Oh, why would I take the risk of owning a stock for a 4% yield, dealing with the market volatility, when I could just buy a bond and get a guaranteed 4.6% from the U.S. government with zero risk of capital loss?
precisely. The risk-free government bond yield marched right past the dividend yields of these defensive sectors, making them instantly much less attractive to income investors. Equity managers aggressively trimmed their exposure to utilities and real estate because the bonds offered a better, safer return.
That is so logical when you lay it out like that.
Plus, for real estate specifically, there is a secondary mechanism. Higher yields mean the cost of financing commercial real estate mortgages and servicing existing property debt goes up exponentially, which crushes their profit margins and property valuations.
That makes total sense. Now, let's talk about the commodity wipeout, because this was another huge surprise in the data for me. We just spent this entire deep dive talking about massive inflation fears, right? 6% PPI.
Right.
Normally, traditional financial theory says when inflation spikes, you buy gold. You buy hard assets to protect your wealth. But precious metals, the SPG/SPM index, plunged 4.08% this week, and agriculture fell 3.31%. Why did gold and silver drop 4% during a massive inflation scare?
Again, it all traces back to the gravity well of the 10-year Treasury yield. Gold pays no dividend. Silver pays no interest. They are non-yielding assets. It costs you money just to store them in a vault.
Because of storage and insurance fees, yeah.
When real risk-free rates spike, meaning the interest rate you get on a Treasury bond minus inflation, the opportunity cost of holding a non-yielding asset like gold becomes simply too high for institutional traders. But there is a second, more mechanical reason for the drop.
The margin liquidations. I saw this in the notes.
Yes. The dramatic, sudden spike in the 10-year yield caught many institutional trading desks off guard. They had borrowed money margin to buy bonds.
Oh, boy.
When bond prices collapsed as yields rose, those desks received margin calls. They needed to raise cash immediately to cover their losses. So what do? They sell their most liquid, profitable assets.
They sell the gold.
They dumped their gold and silver on the market to raise cash to cover their bond losses. It was a liquidity event.
Wow, everything really is connected to the plumbing of the bond market.
Yeah.
If you don't understand the bond market, you don't understand anything.
It's the foundation of the house.
So, with the soft landing narrative officially dead and buried, complacency completely evaporated, and the valuation ceiling aggressively lowered, how should we approach next week? We are looking ahead to the week of May 18th to the 22nd. Where does the smart money go from here?
The macro forecast strategy from the institutional side is very clear. Downward consolidation and defensive rotation.
Meaning prepare for a drop.
Yes. Capital is going to continue moving aggressively away from interest rate-sensitive assets and highly leveraged small caps. Instead, it will flow into consumer staple and commodity-linked hedges to ride out the stagflation storm.
Let's run through the economic calendar, and rather than just listing it day by day, let's group it by the narrative themes we've discussed. Let's start with what I call the consumer squeeze. We need to see just how broke the consumer really is.
That is the perfect way to frame it. The consumer data points next week will be absolutely vital to see if Friday's sell-off was an overreaction or the start of a deep recession.
On Tuesday, May 19th, we get earnings from Home Depot. We want to see how inflation and 4.6% mortgage rates are hitting home improvement and big-ticket spending.
Very important indicator.
Then on Wednesday, we have a massive triple header for retail earnings. Target, Lowe's, and TJ Maxx. Plus, later in the week on Friday, we get UK and Canada retail sales to see if this consumer squeeze is a global phenomenon.
Out of all of those, Target on Wednesday is crucial. It will shed immense light on that trade-down behavior we discussed with Walmart.
Right. Are lower and middle-income families entirely abandoning Target because the prices are too high? Are they exclusively shopping at Walmart now? TJ Maxx will also give us a highly accurate look at mid-income discretionary spending right before the crucial Memorial Day holiday weekend.
Because if they aren't even spending at off-price retailers like TJ Maxx,
then the middle class is officially tapped out. Furthermore, on Tuesday and Thursday, we get U.S. building permits, housing starts, and existing home sales. With the 10-year hitting 4.60%, 30-year mortgage rates are going to surge past 7.5% again.
Right back up.
Are home builders freezing construction? If housing starts plummet, it shows the bond yield spike is immediately physically chilling the real economy.
But the undisputed heavyweight title fight of next week, the Clash of the Titans, happens on Wednesday, May 20th. Let's call this the Tech versus Fed showdown. Because on the exact same day that the FOMC releases their highly anticipated Federal Reserve meeting minutes, we get earnings from NVIDIA.
It is the ultimate market showdown. You could not script a more dramatic collision of narratives. It really is. You have NVIDIA, which single-handedly represents the unstoppable force of AI growth and the tech euphoria we saw on Monday. Their forward guidance on their new Blackwell infrastructure architecture is going to completely dictate global tech momentum.
The whole market hinges on it.
And it is going head-to-head on the exact same afternoon with the immovable object of Federal Reserve hawkishness.
Everyone on Wall Street is going to be microanalyzing the Fed minutes. They will be hunting for any clues, any subtle phrasing on how many voting members under the new Kevin Warsh regime are actively discussing rate hikes instead of cuts.
And if they find them.
If those minutes are hawkish, expect another violent bond market tantrum. And if NVIDIA misses their earnings estimates even slightly, or if their forward guidance isn't absolutely flawless, given the multiple compression we saw this week, the sell-off in the tech sector could accelerate drastically. The valuation ceiling is so fragile right now that perfection is the baseline requirement.
So if you are a retail investor listening to this right now, looking at your retirement accounts, the message here is to radically adjust your expectations and brace for volatility. The buy everything, stocks only go up phase of the market is over. We are firmly in a stock picker's market, and it is an environment entirely dictated by the bond market.
The complacency has completely evaporated. The massive VIX volatility spike on Friday tells us that institutional trading desks have already structuralized their defensive hedges. They are expecting pain.
Right.
Any macroeconomic disappointment next week, a bad housing number, a hawkish Fed comment, an NVIDIA miss is going to meet significantly less liquidity in the market, which means wider price gaps and faster, deeper drops.
Okay, as we wrap up this incredibly deep dive, I want to leave you, the listener, with a final provocative thought to mull over, something that builds on everything we just discussed regarding the bond market and inflation.
Go for it.
We've always been taught in traditional finance that U.S. Treasuries are the ultimate safe haven during geopolitical crises. When the world gets scary, you buy U.S. government debt.
That's the textbook move.
But think about what we learned today about the physical reality of this market. When inflation is driven by physical, unyielding supply shortages, like a billion missing barrels of oil due to a naval blockade in the Strait of Hormuz holding dollar-denominated debt, suddenly introduces massive systemic duration risk.
Huge risk.
Your bond yield might be 4.6%. But if real-world inflation is structurally trapped at 6% because we simply do not have enough physical energy to run the world, you are guaranteed to lose purchasing power over time. So if bonds are actually the source of the market's volatility and tech stocks are simply too expensive given the multiple compression, what does a true safe haven even look like in the second half of 2026?
Is it commodities? Is it cash? Is it productive farmland? That is the structural puzzle every portfolio manager on Wall Street is desperately trying to solve right now as the water just keeps rising in the basement.
They're scrambling.
The old 60-40 portfolio rules simply do not apply when the structural foundation of energy is broken.
It's a completely new paradigm, and it requires a completely new way of thinking about capital. Well, if you enjoyed Wall Street Weekly's market analysis, subscribe and leave a comment wherever you listen to your podcasts. And follow us, Wall Street Weekly, on YouTube, so you never miss a market update. We will be back next week with more weekly insights and analysis from Wall Street. Thank you for listening.